Welcome to today's webinar, Strategies to Exit Your Business and Retire. We're really excited to be discussing this topic with you today. Recent studies have shown that 66% of the current American business market is owned by baby boomers, and the most recent census indicates there are about 8 million businesses in the United States. So if we just extrapolate this data, that means that there's going to be more than 5 million businesses owned by a generation that will be looking to retire within the next 5 to 10 years. My name is Kristen Tafe. I work in the valuation and small business consulting space. I enjoy helping clients with succession, and I've been involved with transactions on both an internal side, selling to key employees or transitioning to family members, and on external transactions where we've actually worked with the clients to find that potential buyer and then negotiate and hopefully close the sale. Also presenting today are Chad Flanagan and Brad Kelly, and I will have both of you guys introduce yourselves. Brad, would you start?
Sure. Thanks, Kristen. Hello, everyone. Thanks for joining us today. We're really looking forward to sharing our thoughts with you on a topic that, as Kristen said, is very active and has been active now for the last couple of years. And so we're excited that you joined us today. My name's Brad Kelly. I am the principal in charge of our financial services group, where we do work with clients in the area of wealth and financial planning, providing consulting around many aspects of individuals' wealth planning picture. In addition to that, we do provide investment strategies and solutions to our clients, as well as insurance strategies. And we'll be talking more about that in a bit. Chad?
Yeah, thanks, Brad. I'm Chad Flanagan. I'm the partner in charge of our business valuation group and work very closely with Kristen to help clients, most often in a transaction opportunity, buy side or sell side, also sometimes in litigation, or sometimes in wealth planning, and work closely with Brad and his team in an overall comprehensive, holistic approach to wealth planning. And so we look forward today to talk about a little bit about that process and talk about even a little about the emotions involved in this process.
All right, thank you guys. So succession planning is such an important conversation. There are both quantitative aspects, identifying what a business is worth and what other financial resources you have to support your retirement. And there's also emotional considerations like Chad just brought up. And it really brings into question somebody's own mortality and thinking about, what do I want to do in the years following being a business owner? What are my goals for those years? Our learning objectives today are to identify the top considerations during succession planning, explore options for transition operations, and identify what steps you should be taking now to ensure future success in this process. So what is exit planning? Exit planning is a very comprehensive process. It's not just saying, hey, my business is worth $10 million. I'm going to take that and retire to Fiji. It's really identifying your goals for a comfortable retirement. It's minimizing tax implications and maximizing the return or that sales price for your business operations. And it's a long-term planning process. It's not something that you really want to accomplish in just a short period of time. If you put effort into it ahead of the actual transaction or, ahead of that retirement date, you get to stay in control of the process as opposed to being forced into a corner due to a short timeline and, just having to take whatever you're being offered. Really, it's just a good business strategy as well. It pushes forward conversations about reducing key person dependence on an owner and transitioning leadership to different people in the organization. It makes an owner think about, well, who are my potential buyers and what would they value in this company if I was going to sell to them? And that can really help to maximize value and will shape your strategic goals. There are 7 components we're going to talk about today in exit planning. So the first one is to identify the owner's exit objectives and goals, quantify business and personal financial resources, potential business value enhancement, focus on improving your operations before a sale. Then you have to consider your transfer operations or how you're going to transfer those operations. You could transfer to third parties, you can transfer to insiders. Business continuity planning, how do we continue these business operations and ensure that it's not just going to close once new owners take over? And then it really ties into that personal wealth and estate planning. All right, so we're going to go through these now and dive into them a little bit deeper. So the first one to think about is identify your goals and objectives. In this step, the goal is to identify what you want to accomplish in leaving your business. And oftentimes that goes beyond just basic objectives. So basic objectives could include, how much longer do you really want to work? When do you want to leave these business operations? So even if you were to sell today, are you willing to maybe stay on for a couple of years to transition those operations? Or do you want to be out as of a certain date? To whom do you want to transfer? Are you going to just hand the keys over to anybody, highest bidder gets it? Or do you have more of a, I want it to be this person because I like that they'll support the culture I've already created? And then the last thing to think about is, how much money do you need to have the lifestyle that you want and that you've worked hard for over the last, the business operations, the business cycle? These are very key objectives that need to be considered. There are other value-based objectives to consider as well. So in addition to thinking about what's the top dollar I can get for these operations and how do I minimize my taxes, there's these qualitative goals to think about. So those really include family harmony. This could mean transfers to children, other family members, but it could also mean selling to an outsider. Either one can be done for the benefit of the family. Thinking about the owner's legacy. You are justifiably proud to have created a business that has ran for a number of years, and owners can fear that in selling their business to a larger company, your own legacy may be diminished. So that's definitely something that you should consider. Maintaining culture, the company's personality, it's the way that you as the owner and your coworkers think, you feel, and you act. Oftentimes there's also pride in just the culture that you've created. So if you fear that the culture may be eroded in a potential transaction, it's really going to change who you're looking to sell to. Community involvement. Your business may be a cornerstone of the community. If your business is providing, helping to put food on the table for many community members, roofs over their heads, then you'll feel very, very proud that your business impacts the community and you'll want it to stay in that area. A question to ask yourself in this situation is, what is my business for the company without me? And what is my vision for me without my company? So just thinking about that either way. What do you want to continue into the future? And that will play into those qualitative aspects. So the next component of successful exit planning is to think about the understanding the business value and your personal financial resources. So once we understand your objectives, then we have to quantify that data. This determines if there's a gap between what you need in order to fund your retirement and what you currently have. So with this step, we're going to analyze the current value of the business and the estimated cash flow that you anticipate to receive from the business. So this can be a combination of current compensation and distributions. It can be the sale proceeds, and what other aspects of that if you have a seller note and it goes into the future. So there can be a lot of things involved with the cash flows from the business. This is the business valuation piece that Chad will touch on later in this webinar. And then we also have to quantify the personal financial resources or your non-business assets. Most business owners have about over 70% of their total assets tied up in the business operations. So Brad is going to discuss how the business operations and those non-business assets play into your wealth management goals. Brad, do you want to jump in?
Yes, thanks, Kristen. And as Kristen said, and as we've worked with clients, I have found that clients spend a lot of their time, the majority of their time, building and running their business. And at some point in time, they start thinking about the exit of the business, leaving the business. What is that going to look like? And then their attention turns from running the business to what does that exit event look like? And rightfully so, thinking in terms of what's the right value for my company, how do I exit, who do I sell to, and really just focused on that. What I do find, what we find, is that there's a little bit of attention being put on what happens after the transaction, not just a year or 2 years after the transaction, but thinking in terms of 10, 20 years out. And so it's really important to take the time to go through a process to really think in terms of what does that look like? What am I trying to accomplish? And what is the best roadmap to getting there? And so that's the wealth planning process that we go through. And we try to take something that's very complex and help the business owner really transition from being a business owner to a wealth manager. Because you're, as Kristen said, you're taking an illiquid asset that represents maybe 70% of your net worth and turning it into a liquid asset. So how do you manage that on a going forward basis, and what does that look like? So what we do is try to take the complexity of that and simplify that in three basic questions. And really we start with, all right, what do I have? That's the first question. What do I have? What do my assets look like today? How are they organized? What do I need as I look out going forward to maintain the lifestyle that I've grown accustomed to, or that I want to maintain as I go forward? And then how do I get there? And so there are a lot of moving parts within that. If Amy, you can go to the next slide. So the components that need to be looked at when contemplating what does the picture look like after the transaction needs to take into account these blocks here that you see, these components. Tax is very important. Tax is important not just at the time of the transaction, but also on a going forward basis. What does my tax picture and landscape look like as I go out into my retirement? Investments, very important. Again, taking a very illiquid asset and turning that into cash. How do I deploy that in a way to protect it, but still allow it to grow and still utilize then that pool of assets to live off of during retirement? Insurance and protection is very important, because what we find is that the need for insurance coverages during the time of operating the business and working changes once a client retires. There's still a need for protection, but the need for it probably changes and the objective changes. And then the last two components is really finding that balance between what do I want to preserve and transition to the next generation without jeopardizing my lifestyle and my retirement goals and objectives, and finding what that balance looks like. So what I want to do is show you a platform that we utilize to help clients organize these different components and really look at it in a way to forecast out into the future to see what the picture looks like. So with that, I'm going to share my screen. All right, so this is a platform, as I said, that helps clients take the topics that we're talking about today and organize them in a way to really look out into the future. So I'm going to start with the profile of this client. This is pretty typical. When we start working with a family that is thinking about exiting a business, this is not uncommon. Typically, we'll work with clients that are in their 50s or 60s. Occasionally, it will be in their 40s, but typically it's 50s and 60s where the exit event is typically taking place. In this example, we have a husband and wife. You can see their current ages here. And we are targeting, in this case, a transaction or an exit out of the business in 2023. And I'll show you what that looks like here in a bit. But in addition to husband and wife, we also want to understand the totality of the family, the stakeholders, if you will, so that we can think in terms of that balance, as I said, between retirement cash flow priorities and then what is eventually going to move on to the heirs. So in this case, we have 3 children. A couple of the children are married, and then a couple of grandchildren. And so this is our basic profile. Now, remember, I said there's 3 questions that need to be asked when thinking about this transition into retirement. Number 1 is, well, what do I have? So we'll start there and look at, in this case, what this particular client has. So we're going to look at a net worth statement, and this is how we organize it. So we look at, from a net worth perspective, we look at, first of all, liquidity of the client, and really breaking that into non-retirement accounts and retirement accounts. So up here, this particular client has in cash in a money market fund about $400,000, an investment portfolio that's grown over time of just under $1 million. Probably last year it was well over $1 million, and given what the markets have done this year, it's now come below that. Then we look at retirement accounts. And so you can see we have both clients have participated and contributed to a retirement program over their working years. And we add all of that together and we have liquid assets of $3.2 million in this case. Then we move down into the illiquid areas and we look at the business interest. And so as Kristen said, this is pretty common. We see the largest asset of a business owner is their business. And in this case, and this is pretty common too, that we see it broken down into two components, if you will, the business itself, and we're showing a value of $8 million, and then real estate that the business utilizes to operate in. And so in this case, we're showing $2.8 million. So between the real estate and the business itself, we're showing about $10.8 million of value. In addition to that, we've got a couple of assets that are utilized for day-to-day living. So we have primary residence in this case of $1.5 million, depending on what part of the country you're in. So I'm showing a beach home. If you're up here in the Minnesota Dakotas, it's probably a lake home. But in this case, a second home of about $1 million and then some personal assets. So we're showing in this case a net worth of about $16.8 million. So that's our starting point. What do I have? That's the first question. The second question is, what do I need? And so that's where we go into building out a forecast and looking forward based on the objectives of the individual, of the family. And so this is going to look very spreadsheet-like, but what we look at here is year by year, and we're looking at what happens or what would we expect to happen given our inputs on a year by year basis. And then we have corresponding ages for that year for the clients. So the spreadsheet is broken down into the first several columns are really looking at what do we expect for cash coming in, cash available or coming in so that I can live off of that on a year-to-year basis. This first year, we're showing some salary wages coming in from the business. In addition to that, we're showing other income, which would be rent from the real estate. It could be distributions from the business, but in this case, we're showing for this year about 1.4 million of inflow. And then we're showing here, what do we expect for outflow for living expenses, general living expenses day to day, insurance premiums that maybe I have in place, taxes that I pay. There could be a number of things making up this number. But in this case, we're showing 1.2 million that is going out. So 1.4 coming in, 1.278 going out. I have a surplus of about $133,000. Okay, so that's maybe how this client accumulated the investment account, having some surplus dollars each year and then investing it in the investment account. And then we're showing the projected value of the liquid assets that I mentioned earlier at the end of the year. Now in year two, as I mentioned, the client is looking at selling in 2023. So the salary goes away, but we have the proceeds of the transaction here, and we're just showing the selling the enterprise itself, but not the real estate, holding onto the real estate, which we typically see, and having then the rental income going forward. But the proceeds from the sale, and then over here, we're showing living expenses. There's going to be some sort of tax liability associated with the sale of the business. And so we have to prepare for that. And then at the end of all of that, then we look at what's net left over that replenishes or goes into the investment accounts. And as I said before, the business owner is moving from business owner to wealth manager, and you can see the impact of that here. Now there's a portfolio of $10 million that needs to be managed in a way that's going to provide lifestyle going forward. Because as we look out into the future years, we no longer have wages. We have no income coming in other than some rental income, but our expenses haven't changed. We still are living, we're traveling, we're doing things. And so once we forecast that out, we're looking at each year, what are we going to need to pull from the investment accounts to sustain that standard of living that we're trying to accomplish. And so as we pull down out of the portfolios, we really want to watch this column here to see what's happening to that portfolio as we go forward. And in this case, we're showing there's still growth on the portfolio, and we're assuming about a 6.5% rate of return on the portfolio. So you can see we're not drawing down on principal until we get out into the later years here. So that's really kind of setting that baseline of that question of, what do I need? We've established that baseline of what do I need? I know now that if I sell at $8 million, I pay taxes, I put that into an investment account, growing at 6.5%. And for my personal living expenses, that's sustainable. So that's answering that question. The last question is then, how do I get there? Now that I've established that, now I go to a different part of the platform to really look at a number of aspects and levers, I would say, associated with the plan. So what I'm looking at here is a graph of that last column that we were looking at on the previous slide, the spreadsheet. It's the portfolio assets in graph form. And you can see we're showing modest growth, as we showed you on that spreadsheet. As we go out into the later years, a little bit of a drawdown, given what I'm forecasting for my expenses. So that looks pretty good. So clients may want to look at that and go, okay, well, if that's the case, I'd also like to join a country club and spend some of my retirement years playing golf. So I've got an initiation fee of $100,000 and annually about $15,000. If I turn those buttons on, the software recalculates that and adds that expense onto the baseline, what do I need facts that we were looking at. And you can see a little bit more of a drawdown once I do that. All right, so now I've looked at, I'm doing some of the things I want to do. But let me think about, what if I give my kids $40,000 a year for the next 5 years once the transaction occurs? So we show now a much steeper drawdown in the later years if I do that. But still, we're still cash flowing out into the later years. So now you might want to look at, all right, I'm doing some of the things I want to do. I'm doing some things for my kids. Now, if I want to give to charity as I go forward, if I turn that button on and the software recalculates it, now we've drawn down my assets by doing that. So this is a nice way to kind of look at, I've established my base facts, and now I want to do some other wishes, if you will, and can add that to the platform. So let's say that Kristen and Chad do a great job of working with you, and they drive the value of the business up from 8 million to 10 million. And we look at selling this year. And so if we turn that button on, and instead of getting 8 million, we get 10 million, look at the change now. So now not only do am I able to take care of the baseline facts that I've set out, but I can also do the other things that I want to do. And so now maybe I take some time to really think in terms of, what can I do to drive the value of the business up? And that's where Chad and his team just do a great job of really helping with that. Okay, so I showed you before that I'm showing you about a 6.5% rate of return year in and year out. Now, if you have any dollars in the market this year, you know that does not happen every year, right? Some years it's higher than that. Years like this year, it's much lower than that. So if we actually look at, all right, let's take into account market conditions, because I have to invest the portfolio in a way to grow, to sustain my lifestyle. So if I look at a typical market condition, just apply that here, now I probably get a better picture of what this might look like as it calculates. And so it'll take a few minutes, because the software is actually looking at historical volatility of the market and showing this is probably a more realistic picture of what it would look like. Given certain risk parameters that I take on in the portfolio, I can withstand the ups and the downs in the market and still draw from the portfolio and achieve what my goals and objectives are. I'm going to go back to this piece and go back to the year in and year out 6.5% rate of return. Now, this is just liquid assets here. So we also want to take into consideration that we want to look at the whole picture as we forecast out into the future. So we want to look at, in this case, there's a lot of information here. I want to focus on the two columns here. This is the graph we were just looking at, this column, portfolio assets. But if you remember, we have other assets. We have the beach home, our primary residence. We have the real estate as well. So we also want to keep an eye on the net worth. We want to keep an eye on our liquidity, and we want to keep an eye on the net worth as we forecast out in the future. Now, why is that important? Well, that's important because we want to look at, all right, we know that our cash flow is taken care of. How do we now look at the transition of our wealth to the next generation? And this is where we remember the components we were looking at earlier, the blocks, if you will, and the estate was one of those blocks, right? So we need to understand, how do we transition wealth to the next generation? And so we look at estate planning documents and flow chart that out so we can see how the wealth flows through the estate and ultimately down to the heirs. And so that's in today's dollars that we're looking at that. If we forecast that out into the future, and we'll just go out to, let's say, age 75, you can see now when I turn those buttons on over on the left-hand side, if I'm going to give to charity, give to my kids, and also have the lifestyle that I'm trying to achieve, what does that look like in the future? What does my net worth look like? What have I moved outside of my estate by making the gifts to the kids, by making gifts to the charities? What does that total picture look like? And can I do some things to really, at the end of the day, minimize this box right here, which are the expenses associated with transferring your estate from one generation to the next. And so that's made up of taxes and other costs that are associated with that. So again, an important part of the overall wealth plan, your lifestyle objectives, and then the transition objectives. And to wrap this up, I'm going to go back to this graph that we were looking at. I'm going to shut the buttons off here to go back to our baseline facts. And end with this, because I think it's important. This is a great picture to look at, right? It makes you feel pretty good. But I think it's also important to stress the plan and understand where the risks are. So let's just say that you didn't utilize Chad and his team, used another team working with Valuation, and we sold the business at $6 million instead of $8 million. You can see the impact of that. Now I cannot accomplish my goals and my objectives that once I retire, I'm going to have some challenges now. So I need to maybe consider some other options than to maybe sell at this point or change what my goals and objectives are. So that's one stress point. The other one is the rate of return. And I'm going to turn on, instead of 6.5%, 5.1%. And look at that. All right, much steeper drawdown. So, and I'll end with this is why it's so important to look at all the components of this wealth plan and know how they interact with each other, because the investment portfolio is a tool. It's a means to an end. So it isn't about trying to outperform the S&P 500 or looking at the neatest, coolest thing out in the investment world. It is a tool to accomplish my goals and objectives. And so how do I design the portfolio in a way to make that happen? And again, the purpose of that was just to share with you the importance of kind of post-transaction, mapping that out and understanding a very complex and sometimes intimidating conversation, trying to put that in a very organized kind of way. And with that, Chad, I think I'm turning it over to you.
Thanks, Brad. And Brad, I'll just ask you on this polling question, how many clients come to you and know their number? You know, we talk about knowing what you need in retirement. I imagine these tools are incredibly helpful for that.
It is, you know, so it's very seldom that somebody comes to us and they know their number. And as I said earlier, you know, business owners they're running their businesses every day. They're building their businesses. They're focused on that and really haven't taken the time. And like I said, rightfully so, to really think in terms of what is that right number. I've built this business. In conjunction with that, I've built a lifestyle as well. And so how do I match those two together as I look at the transition?
Yeah, and we'll talk a little bit about if you're a business owner, and so many business owners have 80-90% of their net worth wrapped up in their business. It's tough if you have a privately held, closely held business. It's not traded on the market. You need help to understand the value of that business. So there's lots of reasons to get businesses valued, and Chris and I are waiting for your call to help you out with that. But we're going to talk about a few today. One, the most obvious is if you get an offer on your business and you're actually entering a conversation about selling your business. It's nice to know, even if it's not a formal business valuation, that you can have some recent market data. You can understand the key value drivers in your business, understand normalized earnings, all those type of things. So we like to work with clients that prepare for those type of events and really understand year in, year out where the value of their business is. But most often it is a trigger event of a potential offer. Brad talked we talked a lot about knowing your number. Same with business valuations, that we see so many entering into retirement saying, I'm really looking for 5 million out of my business, and they'll come to us and we'll say, we have bad news. It's probably worth half that. And then we start talking about that retirement horizon and getting to work on how to bridge that gap. And that can be the obvious things like growing revenue, improving margins, increasing cash flow. And sometimes it's about reducing risk and working through those issues and trying to get a better multiple. I think too, when we think about valuing closely held businesses, family businesses, you don't see the marketplace every day and ride these roller coasters where the value in the public markets is very volatile. The truth is that probably your company has more volatility too. You just don't see it every day, so it doesn't feel like it. But buyers and sellers buy based on earnings, and so much of it's forward looking. So as the economy shifts or as your markets shift, so too does your business value, and it's good to have a look into those things. So we like to get involved and help businesses to grow the value of their business. We think that's an important tool to help with management of a company. One of the most important goals of a shareholder or a C-suite or management team is to increase shareholder value. Again, a closely held business, it's hard to know if you're moving the needle on that. You can look to revenue and earnings and those things, but it's nice to put it all together and once a year or once every few years, see if you're increasing shareholder value. This can raise a lot of confidence for your team to know that they're in a growing company. And I think it's very helpful as well to have that valuation methodology increase people's education and knowledge about how the business is valued. And they can kind of press on those value drivers and help increase the value of the business and feel a part of that. One other thing that we want to mention is just if you're thinking about exiting your business, sometimes that is the family members, and you put on a different hat and you think, how do I minimize taxes? We do sometimes then value the businesses to take advantage of some discounts for lack of control and lack of marketability. And this helps minimize taxes. And so important to understand the impact of discounts. And again, educate your team about how all this works, because when you do that after a triggering event or in a dispute, it's very difficult. And Kristen and I have worked in lots of litigation cases where they were arguing about standard of value, if discounts apply, what valuation methodology is most appropriate, and nice to have that kind of figured out ahead of time. So there are some things as you think about how do I improve the value of my business. The most obvious are revenues, earnings, cash flow. That's what's attractive to buyers. But if we move past the quantitative stuff and into the qualitative factors, I think there's no more important thing than building out your management team, especially in small business. So there's so much key person dependence on that owner that sometimes there's not a lot for sale if that owner is retiring. So building depth there, I know that's difficult in this labor market, but working with them, developing them, giving them some opportunity, not only helps with retention, but makes the value of your business go up. Operating systems are important. Buyers are looking to see, can I get quality data? Is this all smooth and running, or do I have to come in and put some money into things and redevelop a new system, which causes disruption? So if you have that all figured out, preparing for that exit. The third one here is sometimes difficult. We do work with clients that have one customer, and in those situations, there's a lot more risk that puts downward pressure on multiple. So if you can diversify in customer base or products or even geography, those can be helpful, reduce risk. And just a few more, it's buyers aren't always doing sophisticated discounted cash flow models or things like that. Sometimes there's a gut feel to these things, and there's no better way to turn off a buyer than have a facility that's in disarray or equipment that's not working, those kind of things. So taking care of those things, make sure there's not a lot of deferred maintenance. And then maybe a tie to the management team depth is growth strategy. And if you have opportunity for growth in markets and services, that's something that buyers will be very excited about. Having effective financial controls in place and really trying to eliminate as much volatility as you can. All very attractive things for buyers and certainly things that you're probably already working on, but just know that it does drive pricing and buyers' decisions. So, Kristen, I think you're going to talk about potential exit paths for sellers.
Yeah, so you spend some time working on increasing the value of your business. And then the next question that you come up with is, well, now who am I going to sell to? So the first option we're going to talk about is selling to a third party. The upside of selling to a third party is that it may be your top dollar option. You can potentially get paid quickly, hopefully no seller financing. It might be a quicker transition if you're not somebody who wants to stick around for a long period of time. The downside is you may lose control of your corporate culture, and you may have to change the name and the location of operations. So some of those qualitative factors that we talked about at the beginning of this presentation may be lost in a sale to an outside party. One thing that we would encourage you when you're looking at selling to an outside party is don't just focus on the purchase price, really focus on the total terms of the letter of intent. Is this an asset sale or a stock sale? So typically a third party is going to want to buy the assets of the company. So that typically includes the fixed assets, the inventory, and then the goodwill, the blue sky, the intangible value that is really driving this forward and the reason they didn't just build their own next door. They don't want to be stuck with any of the liabilities or the potential skeletons in the closet that may appear if you do a stock sale. So the asset sale really works great for the buyers. They can assign a portion of the purchase price to different asset categories, and then they can really redepreciate some fixed assets. From a seller's perspective, though, it's not always as great because the income that you receive as proceeds is going to likely be taxed as ordinary income. So you may be paying a higher rate of tax on it. So sellers generally prefer a stock sale because then the income is treated as capital gains. It's taxed as capital gains compared to ordinary tax rates. Buyers may be open to a stock sale. It might impact purchase price. So that's very much something that you should be considering when you're looking at those terms of the sale. Another thing you should be thinking about is, how am I going to get the proceeds of the purchase price? Is it 100% cash up front? Is there an earnout that's going to span a number of years? And if so, how reasonable are those earnout targets? Are we likely to actually get those? Should we include those in what we expect to receive to fund our retirement? Earnouts are becoming very common right now. And the earnout is really just, especially post-COVID, when people were saying like, hey, I am going to bounce back and this is how. There was a lot of buyers who were saying like, yeah, that sounds great. I believe you. However, we're going to pay you this once we actually see it happen. So earnouts can have the owners remain in place saying you have to help to drive these operations. And if you hit these metrics, then you receive the rest of the payments. They can also happen without the owners there. So there's just a lot of ways that those can be formed. And is the buyer asking you to stay on for an additional number of years? This goes back to that timing that we talked about at the beginning of the presentation. There's a lot of owners who say, hey, I want to retire in 3 years. And then at 3 years, they like to sell the business. And the new buyer says, but I want to keep you on for 2 more. And so it's really just trying to push those things together to make sure you understand what's the ask of me. Do I really want to be working an additional 5 years, or do I really only want to be working those 3 years, and I should start looking for a buyer now so we can close in a year and then I can stay on board to help transition for 2 years. Another thing to think about in a sale to a third party is what happens to your employees. Will they be happy with the sale to the third party? Will they want to stay and work for them there? Are there any duplicate roles that you're concerned about where, potentially this is a strategic purchase for somebody and they already have a function and therefore they don't want to keep your employees in place? How does that play into you as the seller? Also, does the buyer want to keep your current management team in place? And if so, how do we make sure that that happens? Does that impact a sales price if those individuals leave? So there's just a lot of things to think about there. That's more than just here's what the purchase price is. The other option would be a sale to an insider. An insider may be the other owners that you're already working with. It might be key employees, key employee, or an employee group. You could be sell to an ESOP where then the employees all become part of the ownership through that ESOP. You could sell to children or you could gift to children in the business. So the upside here is that it may be a great way to maintain your corporate culture. You can have some continuity in your business operation, and it really encourages the next generation of leaders to stay invested in this company. The downside is you may not get top dollar. There may be a seller financing aspect here. So the question becomes, how do you successfully transition to an insider? And it's a mix of 3 components. So first, you need to consider the ability, experience, and dedication of those insiders. So ability, do they have the skills necessary to run this business? Experience, do they understand this business operation? Do they understand the industry? Are they prepared to take that on? And dedication, is there a clear-cut understanding of what sort of ask actually being a business owner is as compared to being an employee of operations? These are especially important if there's a seller note, because if you're financing this with a seller note, you need them to be successful, and we need them to, be able to take this on and continue to make payments on that note to fund your retirement. A sale to an insider often works best in a company with a strong, consistent cash flow and little debt, because we know then they're going to be able to make those payments on any sort of seller note. And in sale to an insider, we want to work with some sort of advisor just to make sure that we are considering how can we reduce income taxes from eroding the cash flow available to the seller to fund that retirement and wealth plan. So oftentimes a sale to an insider can be great because they do know the business inside and out, but they might lack the funds, which is why I brought up the seller financing. So with seller financing, we have some different strategies that we can consider here. So there could be some sort of stock ownership program in place where you set certain metrics, maybe growth, new customers, benchmarks, and you measure what the growth looks like. And if the business reaches or exceeds certain goals, then the key employees can, look to buy an interest and buy in with a bonus or buy in with something else like that to ensure that they are getting ownership in these operations. So it ties the ownership into participating in the growth in operations. When you're selling to an insider, you can also consider, do I want to, in a sense, offer them a reduced price just to ensure that they can take this in? So if you're selling to a family member, that could be gifting a portion or all of the shares to them. And then you want to make sure that you're considering those discounts that Chad brought up, the idea of how can we take advantage of the discounts that the IRS allows? If you're offering a reduced price to a key employee, well, then we would have to consider, does this really count as non-cash compensation? And should we be considering any potential implications there? The other option would be consider a multi-year transaction. Should we do this in shorter increments, like, sell 10% per year and allow them to pay that down so that way the seller note doesn't get huge? All right, so this is an example here of a sale to an insider. So this shows a 5-year plan to transition 100% of the company to the next generation of leaders. We helped this client to plan, and we were able to take advantage of both discounts for gifting and certain tax planning strategies. The client transitioned 10% per year for each of the first 5 years, and then we had a stall for 1 year where they just ran the operations. And then in year 6, the remaining amount transitioned to generation 2. They got control of the business operations. And at that point, generation 1, mom and dad were fully out of operation. So they used that 5-year period to not only transition ownership, but to transition leadership and responsibilities. It was really a way to empower it and to make sure that the whole workforce and culture understood the transaction, and it didn't just like knock anybody on their feet that this was happening. The planning that went into this was really the idea of what sort of distributions can we use to help fund the seller note. So in year one, the new owners, generation 2, now have 10% of operations. The note payment is going to be due at the end of the year. So if distributions are issued, they would get pro rata 10% of those distributions, and they're going to use that to help pay down the amount due on the seller note. And so there was a lot of planning there to understand, if we do it this way, if we have a reasonable interest rate in place, what does that mean for total proceeds to seller? And what does that mean for feasibility of making those payments to the buyer? So really these ideas, the goal here is to still be able to identify what is the net value that's going to be received by the buyer. This is going to help the buyer, or I'm sorry, the seller. And that's going to help the seller to understand, how am I going to get this to the next generation? Do I have to make a gift? What's the time frame I need to be thinking about? And it really rolls into the wealth planning that Brad was talking about in terms of knowing what you need for retirement. All right, Chad, back to you for some emotional considerations.
Thanks, Kristen. Yep, this is the part you've all been waiting for. You get to hear your accountants, appraisers, financial advisors talk about the importance of recognizing emotion in your exit planning. But we've learned from experience this is incredibly important. And I'm going to pull Brad into this conversation and just talk about some of our experiences. I think in my early years, I was so excited to draw together some of these plans, minimize taxes, maximize cash flow, really put a good plan in place, and didn't spend a lot of time talking about what our seller's going to do. What is the next chapter of their life? Do they have hobbies? Are they okay? Are they ready to exit? And I had one case in particular where we didn't do that, and the business owner had been developing somebody for a long time, and really had promised a lot of things, got to sign on the dotted line and pulled away, was not ready to walk away from his clients and his employees, and just wanted to keep working, wanted to keep running the company. Ended very badly. Of course, that took away an opportunity from one of their best employees. And we don't want those things to happen. That's the point of planning. And we ask better questions now, and we do a little bit more to prepare our clients. And so we just want to kind of talk about the importance of recognizing some of these and go through that specifically. So Brad, and just in your experience, have you had a few clients that have had a difficult time exiting their business?
Yes, I have. You know, I think that we all have stories that you know, we've experienced. You know, I think that for the clients that we've worked with, you really spend time understanding the emotional aspects of it, because you're trying to understand too. I've found that business owners, either that business is their identity, you know, to take something and start it from scratch and to grow it to, you know, to what it is today. You know, it's very, very emotional, and your identity is attached to that you've put so much of your time and effort into. Letting go of that's very, very difficult. So I think that's one side of it. I think the other side of it is sometimes the unknown of not getting up and going to my company, you know, tomorrow, like I've done for the last many years. Just the unknown of that can be very scary as well. And so we certainly have navigated a number of clients through, you know, both of those situations.
So that's what we mean when we say succession is not just about succession. There's a lot to think about. It's more than the mechanics. One thing we like to do is talk to our clients about their social contract with their business. What we mean by that is we ask them, what do you want for you and your family from the business? So we do that from the seller's standpoint, and just talk about what's the ideal outcome with this. Is it, you know, is it creating opportunities for your employees, your family? Is it top dollar? Is it impact to community? Are there charitable intentions? There's no wrong answers with this. but it's important for us to understand and for the sellers to say those things out loud. But then also with the buyers, if it's an internal transfer, a lot of times we'll approach them and they're not so sure they want to be owners. Maybe they don't have the risk tolerance for it. Maybe it's just a job to them. So those are all important things to really think through. Are you ready for these type of changes?
Chad, I'll just add there too, though. I mean, you think about the sports analogy of sometimes the greatest players in sports are not very good coaches, right? And so, part of that's just like you said, just when you're assessing your team members and you're looking at, a person that might excel in one area may not be the right person to step in and take that lead role as well. And just having those kind of honest kind of conversations and thinking through those things. But how many times have you seen the greatest players, some of the greatest Hall of Famers have not had success coaching? Those are just two different things.
Yeah, I think we see that. I don't know. It feels like half the time, Brad, where the person they told us they've identified as the next leader is not the same person that the team wants to rally behind. And so having a third party facilitator have some of those conversations can be really helpful. So when you think about a successful succession, I think where most clients fail is that maybe they'll get started, but they get busy. They've got growing businesses. There's lots of day-to-day challenges. They don't come back to it. And it is important. It's helpful to have somebody, hold you accountable to keep making progress on these things. So committing to the process is probably the most important thing. We're talking right now just about acknowledging the emotions involved, both with the seller and the buyer. And then we ask that seller put the business first. That's a little bit about what Brad's talking about, thinking about what your role is as you exit, thinking about who that next leader should be. Put the business first, who's most qualified, and let that drive maybe what your role is sometimes. Why is this so hard? Imagine for those of you that are in a family business, I imagine how difficult that is. You're talking about choosing a leader. That means you're not choosing several people. And I think, just owners are busy running day to day. It's very difficult. It's easy to push off. For some, it raises issues of their mortality, and they're really going to be done with this. This has been a great ride. So there's some fear and different things. So you have to acknowledge how difficult this process is. And there are studies that tell us that the longer you do the planning, and it seems crazy to think you have to do this over a 10-year period, but those are the most effective. You're developing people, you're getting them ready to take over when you're gone. And so having that in place helps with the succession of the business. There are studies that if we think about family business specifically, there's just a whole dynamic of other challenges there. Everybody's role, what does compensation look like? How do we make decisions? Do we require people to work outside the business before jumping into the business? So lots of potential areas of conflict. And so having a plan in place, having some sort of governance over how this works is very helpful. Brad, do you see anything else with family business that you see as a challenge?
I think that it boils down to, and I think that you see business owners, how do they view their business? Is it a tool or is it a legacy? And those are two different things. And so I think we've worked, Chad, with clients that view their business as a tool. It's a means to an end, a goal, an objective, a lifestyle, and how you manage to the exit there is much different than if you view the business as a legacy. Yeah. And so that approach is completely different in kind of having that mindset. So I think that's pretty common. You typically in a family-owned business, you typically see one of those two objectives.
So we really covered a lot today. I think our parting thoughts, and I'll invite Brad and Kristen to give their last thoughts too, is just this is an important process. It's hard, takes a lot of work. Don't be afraid to ask for help. Sometimes third-party facilitators can help with this, and it takes a team of people. And so, again, I know everybody's busy with day-to-day work, growing their business, but take a moment to really do some planning and thinking through that potential exit. Brad, Kristen, any other thoughts?
Yeah, I'll just say that this is something, as I said earlier, we've seen the level of activity, the highest level I've seen in my career in this space. And for a business owner, you go through this transition one time you go through it. We do this every day, and have navigated this with a number of clients. And I think that we've seen a lot of things and really can help families and business owners kind of navigate and think about things they didn't even know they should be thinking about, right? And so you get one chance to do this. You want to try to land the plane as best you can. And so I think that's something that we've been fortunate, you guys, to work with a lot of families and seeing successful transitions.
Yeah, I think as a last thought too would just be the idea of, if you anticipate some sort of gifting to somebody will happen in the future, it may be smart to think about it now, just being that the exemption is as high as it currently is. That might come into play for some of you. So just timing wise, that can be something to consider as well.
Good point.
So I think we have our last polling question. Please answer that. And on behalf of Brad and Kristen and I, we appreciate an opportunity to talk about these things. You can tell we have a passion for helping closely held businesses, family businesses through this important step. And there's a lot of moving parts. And so hopefully you picked up a few things today. We appreciate your time, and have a great day, everyone.